Starting January 1st, 2026, a big change just happened. The IRS has moved the goalpost on how we can save for retirement under the Secure 2.0 Act. Now, when I talk about the Secure 2.0 Act, I'm referring to a law that was passed at the end of 2022, and it's basically the sequel to the original 2019 reform bill. While it has been rolling out in phases for years, 2026 is the big rollout. This is the year the IRS will officially change the rules on how your employer matches your money and how you're allowed to save if you're over age 50 on your catch-up contributions. So there appears to be two major shifts. The first shift is your employer now can finally give you a match on your Roth contributions. And the second shift is if you're 50 or greater and you are considered a high earner, which is $150,000 or greater, which will be indexed for inflation, and going into 2026 will be based upon your 2025 reported income, you will lose the choice to be able to save pre-tax on those catch-up contributions. So how does this affect you? If you don't make adjustments to your tax withholdings now, you could find yourself in April of 2027 with a little bit of a tax shock. Please note that I am not a licensed financial advisor. This video is for educational and entertainment purposes only. Retirement laws are complex, and as always, consult with your tax professional or HR professional before making any changes to your plan. So let's dive first into the Roth match. Under the Roth match, your employer can now match your contributions into your Roth account if it is offered within your 401k with that employer. The caveat is that the employer's match contributions are treated as taxable income for that immediate year. And what will happen is at the end of the year, in addition to you receiving your W-2 for your current wages for 2026, you will also get what's called a 1099-R at the end of the year, and that will be for what they call phantom income. And that's going to be the taxes that you will have to pay on the employer match contributions. And that tax will have to be paid out of pocket by either increasing your withholdings throughout the year or in a lump sum at the end of the year when you do your taxes. Another important note is that you're only eligible to be able to do a Roth contribution and receive employer Roth match contributions if you're 100% vested in the employer match contributions going into your plan. If you have any questions about that, I recommend you speak to your plan administrator or your HR department to understand if you would qualify. Now, on the age 50 or plus catch-up contributions, there is a new mandate. It falls under Section 603 of this new act, and it has a new income threshold. So if you're 50 or greater and you're going to be doing catch-up contributions to your 401k plan, which is an IRS allowed provision that allows you to save in addition to the annual max limits since you're getting closer to retirement. If you do earn $150,000 a year or greater, and that will be indexed for inflation moving forward, your 2026 catch-up contributions must go to a Roth IRA under those conditions. The drawback is that if your employer does not offer a Roth option within your 401k plan, and you are considered a highly compensated employee at the $150,000 a year or greater compensation level, and you are 50 or greater, you will not qualify to be able to do catch-up contributions until your employer offers the Roth option to your 401k. Now, in addition to that catch-up contribution, there is also what's called a super catch-up contribution. And this is for ages 60 to 63. And that provision allows you to save an additional $11,250, which is up from the standard $8,000 threshold from last year. So let's look at a quick example. If you are 50 or greater and you do an $8,000 catch-up contribution and it's forced into the Roth, and you're in the 24% tax bracket, That'll be nearly $2,000 extra you'll pay in taxes this year compared to last year on your catch-up contributions. Not to mention the possible tax liability on the employer match, which will come in on the 1099-R form I discussed earlier. All right, so let's do a quick comparison on how this plays out, whether you fall under the traditional catch-up provision or if you're forced into the 2026 Roth catch-up mandate for the highlight compensation of $150,000 or greater. Tax benefit, if you fall into the traditional option, you get the tax benefit of the lower income now for your contributions for this year. And if you are above the $150,000 threshold, you will not get any tax deduction this year, but you will have tax-free withdrawals later when you take money out of the account. The 2026 limits on the traditional, if you are less than $150,000, would be $8,000 up to age 50 plus. And if you are 60 to 63 under the super catch-up provision, you could put in $11,250. Now, if you fall into the 150 plus and you're forced into the Roth function, the same limits do apply, but they will be the contributions will be made with after-tax dollars. So at the end of the year on your W-2, under the traditional catch-up option, you will be showing lower wages as it's been in the past. If you fall into the $150,000 or greater and are forced into the Roth, your W-2 will be greater, and the Roth contributions will also increase your tax liability for that year. So under your employer match, under the traditional catch-up feature, it's always pre-tax. But under the 2026 Roth catch-up, if you fall into the $150,000 or greater threshold, the employer match will be treated as income and you will receive a 1099-R at the end of the year. So 3 things that you're going to want to do. One is look at your 2025 W-2, look at box 3, and if that shows $150,000 or greater, then you're going to be into the higher threshold, which means that you're going to be forced into the Roth on your catch-up contributions, and your employer match contributions will be taxable as income. Second thing you're going to want to do is check into your 401k portal and see if your employer even offers a Roth option within the 401k to make sure that you are eligible for contributions. And the third thing you're going to want to do is get with your tax professional, discuss with them which option you're going to do, and make sure any proper adjustments are made to your withholdings so at the end of the year you do not get a tax shocker. So that wraps it up in a nutshell. Hey, if you enjoyed today's video, please subscribe to my channel. Please give the video a thumbs up so to push the content out to more people. And I appreciate you watching. I'm Mike, and I will see you on the next episode.